Inflation cooling off, giving equity markets a boost. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, the first major data release since the shutdown. U.S. inflation rose less than expected in September, keeping the Fed on track to cut rates.
And the latest tariff twist, President Trump terminates trade talks with Canada and gears up for a meeting with China's Xi.
Plus, the busiest week for earnings is upon us. Nearly $27 trillion in market cap, reports with the Mag 7 leading the charge. That's next week, right?
That's next week. We're already getting some of the tech players, though, maybe not the bulk of the Mag 7, but we got Intel and Matt. Those earnings were very strong. The CFO over at Intel saying that demand is outpacing supply. They returned to profitability. They give an upbeat forecast. PCs are doing well, so shares up 5.7%. I believe if this sticks, it means Intel will have doubled so far this year in price.
All right, very good news for Intel. For Ford, they plan to build 50,000 more F-150s and Super Duty trucks at factories in Michigan and Kentucky in 2026. This will recoup about half the production it expects to lose this year as a result of that fire at a New York State aluminum factory, at the Novelis aluminum factory, Dani.
Well, not just Ford, but markets overall are higher this morning after the release of a long-awaited CPI data. Underlying inflation coming in less than expected in September, keeping the Fed on course to cut rates next week. Let's break down the data with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, the right kind of surprise?
Well, the right kind of surprise. Not a huge surprise in the sense that it was only slightly lower than anticipated. We'll take what we can get. But take a look at the overall numbers. The 0.3 gain in headline and 0.2 gain in core on the month. Better news, and that's something to hold on to. But look where we are annually. There's a 3 handle on core and headline inflation, and that is not a 2 handle, which is what the Fed's target is. So we're not going in the right direction, even if we are going in the wrong direction a little bit more slowly. Some of the numbers of in specific sectors were a little bit of a surprise, too. No surprise that apparel was up 0.7 because that's obviously heavily tariffed. Gasoline we knew was up during the month. Here's a surprise. Housing up just 0.1. Omar Sharif of Inflation Analytics says that that was a probably noise-related number. It may not have a lot of validity because it was such a big drop in housing prices, owner's equivalent rent. Furniture also tariffed up 0.9%. Here's an interesting one, though. Smartphones down 2.2%, and that may be because Apple held the line on pricing when it brought out its new iPhones this year. So it's something to keep in mind as we go forward. And finally, we should note that the Social Security cost of living increase for 2026 is going to be 2.8%. That's why they put out this data. During the government shutdown, they had to have the latest numbers to calculate what the COLA would be for next year.
The iPhones remind me of, I'll never forget when a reporter told Ben Bernanke that you can't eat an iPad. By the way, the White House says just now, coming over the wire, there will likely be no release of the inflation data next month, which is interesting. Don't they legally have to put out some release for the COLA increase for Social Security recipients?
It's based on third quarter averages, and so September was the last month of the third quarter. The farther we get into October, the longer it goes, the less time they will have to collect data. We saw this in 2013. A lot of the data comes in electronically now, so that would still be available, maybe half or so. But if you're not collecting the rest of the prices, you're not going to get a scientifically valid number. So people have asked me, well, does this mean the Fed's going to cut rates at both October and December? December, who knows? Because they're not going to have any data, maybe. And it's better when you walk into the dark room, as they say, you want to avoid the furniture.
Well, I think we all hope that this government shutdown is resolved by then. Michael McKee, thanks for joining us, Bloomberg's international policy and economics correspondent. Now, Ford's CEO, Jim Farley, says the production of the company's top-selling F-150 pickup will bounce back after a fire at one of its key aluminum suppliers. I spoke with him yesterday on The Close.
We're still working through it. It'll be, I'd say, around 100,000 units, but we still have the opportunity to improve that. This is really a retiming of wholesale. what we lose this year, we'll gain most of it back next year. Maybe $1.5 billion to $2.5 billion of EBIT this year, a little bit heavier on the cash because of how auto works. But we'll be gaining at least $1 billion, if not more, of that back next year.
For more on Ford, we're joined by Bloomberg's auto reporter Keith Naughton. He covers the company out of Detroit. And Keith, this was interesting yesterday. The market has known about the Novelis fire for a while now, and I guess the shares rallied on a little bit of relief that Ford is going to boost production to try and bring some of that back, but it's still going to cost the company quite a bit.
Oh, for sure. But there was relief, Matt, because they feared it would be far worse. The loss will be about 100,000 units. The financial loss will be 1.5 to 2 billion of EBIT. But as you just had Jim Farley saying, they think they can make a lot of that back. And the other thing that sort of counterbalanced and helped drive the stock up is that they had a very strong third quarter. It was a big beat, and they're selling a lot of very profit-rich SUVs and pickup trucks.
What about this message from the president on Truth Social, Keith? He said Ford and General Motors up big on tariffs placed on big and mid-sized trucks coming from other countries. Is that why Ford and GM are up big, Keith?
Well, I mean, Jim Farley did thank the president in his comments to the analysts on the phone. And his CFO, Sherry House, said that the tariff impact will be reduced by $1 billion based on these newest tariffs and the proclamation from October 17th that extended tariff breaks for automakers to 2030. So they did get relief on tariffs, and both GM and Ford reduced their tariff impact numbers this week.
All right, Keith, thank you very much. That's Bloomberg's Keith Naughton in Detroit. And we're going to have more from Matt's conversation with the Ford CEO in the next hour. First, other earnings that hit the market post-market close yesterday. Intel, those shares climbing 5.8%. Their sales forecast was below Wall Street estimates, but that's because some analysts were still including revenue from a unit that Intel just spun off. Bloomberg Tech co-host Ed Ludlow joins us from San Francisco. Ed, digging through Intel's results, how much of it is starting to factor in the various partnerships and investments they have from the government, from OpenAI, from SoftBank, versus just like a classic PC kind of market for them?
Yeah, the plan in the short term was to strengthen the balance sheet, and they probably added $15 billion in that sense in the quarter. They also paid off $4 billion of debt. The one partnership that isn't accounted for yet is the NVIDIA investment. That $5 billion stake or investment will close at the end of the current period. But, basically, the stock is up, Dani, because in aggregate, the turnaround, they are producing evidence that it's working to an extent, at least based on financial metrics. But the environment for them was a lot better than perhaps they had thought. PC processors is still their bread and butter. And, Windows had a refresh, AI PC is strong, they benefited from that. But they're also finding a little bit of a foothold in data centers and servers, noting that they don't do the sexy bit. They don't do the GPU that NVIDIA does. But their argument is that the hyperscalers and other data center operators realize that the CPU is ready for a refresh. And so they're investing, and Intel's a beneficiary of that.
Hey, at my weekly dad lunch, the topic of conversation has been whether or not ChatGPT will be a monopoly. And I see you wrote a story yesterday with a couple of your colleagues, Davey Alba and Rachel Metz, about Alphabet working with Anthropic. What's the deal?
Yeah, I mean, Anthropic is a frontier model lab, an AI lab that has just intense demand for compute. This confirmed our reporting from earlier in the week, right? But 1 trillion TPUs, 1 million TPUs, 1 million of Google's custom processors is a massive win and validation of their custom technology for both running models, inference, and training them with Anthropic, who historically have been very closely aligned with Amazon. And so, that was a very interesting dynamic to play out this week. It's not been a very good week for Amazon and AWS, frankly. So the fact that Google's willing to back Anthropic at that level with the compute they need would suggest, to answer your question on ChatGPT, that Claude, the models that Anthropic makes, are seen as market leading and a contender. But I would say that the difference between ChatGPT and OpenAI and Anthropic went very aggressively and early for enterprise business, not for the consumer. And now OpenAI is kind of acknowledging that they need to catch up in that enterprise domain.
If it were OpenAI, Ed, then it could be 1 trillion TPUs.
I know, and I misspoke, sorry.
No. Yeah. I mean, in this day and age, I wouldn't initially or immediately disbelieve that number. Ed Ludlow is the co-anchor of Bloomberg Tech. That show kicks off at 11 o'clock, a show you don't want to miss, even on a Friday. Let's get a check on futures, because on this Friday, we're looking at a rally to what could be another record close. Right now, S&P futures up 0.6%, NASDAQ futures up almost 1 full percent, about 0.9%. So we could see new records on both of those benchmark indexes.
Thank you, CPI. Now look at some of the other movers that are on our radar this morning. Deckers, which makes Uggs and Hoka's, is plunging. 2026 sales look weaker than anticipated. Analysts say it might be a conservative outlook. I don't know if the issue is the consumer. The CFO got on the earnings call and said that people are worried about tariffs and higher prices, so they're not buying. Or is it just that nobody wants Uggs anymore?
Well, I certainly don't, but
I'd be surprised if you did.
Tastes change, so maybe, I will by this Christmas. P&G sales, Procter & Gamble sales, topped estimates led by beauty and razor products. P&G maintained its outlook for the fiscal year, and as a result, those shares are up 2.5% in an up market.
Yeah, and it just shows that people are willing to pay up for brand names like P&G, so not everything is weak for the consumer. We also heard from precious metals miner Newmont. Their 2026 guidance for gold production is the same as 2025, which disappointed analysts and shareholders, especially given the run that gold has been in. Shares down 5.5%.
All right, coming up, President Trump halts trade talks with Canada over a tariff, an anti-tariff ad. Plus, he heads to Asia for a high-stakes meeting with China's president. We'll round it all up for you next. This is Bloomberg Open Interest. Getting out of high interest, look what's making headlines around the world. Jane Street, Citadel, and other non-bank firms now command a fifth of global trading revenue and could hit 30% by the decade's end, according to Boston Consulting Group. Fueled by tech and lighter regulation, they're overtaking banks like JP Morgan and Goldman Sachs as top market makers, and Jane Street alone raking in $10 billion last quarter. JP Morgan Chase plans to let institutional clients use Bitcoin and Ether as loan collateral by year-end, deepening Wall Street's crypto embrace. The program will rely on a third-party custodian and expands the bank's acceptance of crypto ETFs as collateral. The move is a symbolic shift for CEO Jamie Dimon, once a fierce Bitcoin critic, as major banks warm to digital assets under the Trump administration's lighter regulatory stance. President Trump is shutting down trade talks with Canada over an ad campaign funded by the government of Ontario. The ad uses quotes from former President Ronald Reagan's address in 1987. Here's part of it.
Throughout the world, there's a growing realization that the way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
President Trump, reacting on Truth Social, wrote, quote, Canada is trying to illegally influence the United States Supreme Court in one of the most important rulings in the history of our country. And he even said that President Reagan loved tariffs, which makes me think I wasn't there in the 80s. Let's bring in Brendan Murray, who leads our global trade coverage. Brendan, I was there in the 80s. And President Trump, although he did put tariffs on some countries and industries, was most definitely anti-protectionism and pro-free trade.
Yeah, absolutely. I think what President Trump has done with this tantrum that he's thrown against the Ontario government is turn a lot of people to President Reagan's old speeches about how free trade is really the path to prosperity, not tariffs. And so this could complicate the talks that are going to start in the weeks and months ahead between the U.S. and Canada and Mexico. They need to review the USMCA by the middle of next year. And so this really isn't a great starting point for those negotiations to get going. But by the same token, the president of the U.S. didn't threaten tariffs. He just threatened to suspend talks. So there seems to be some room for Canada to either apologize or retreat in some way to get back in President Trump's good graces. But it definitely leaves the two sides in a sticky situation if they're going to reach some sort of agreement on the USMCA negotiation by the middle of next year.
At the very least, it shows that negotiations and talks and sentiment can turn on a dime. Brendan, we're also awaiting a meeting between President Xi and Trump next week at the end of this month. What's the expectation?
Yeah, well, first we're going to see Treasury Secretary Scott Bessent meet with his Chinese counterpart in Kuala Lumpur through the weekend. They need to extend the truce that expires November 10th. It's going to be a tough ask, though, because both sides have ratcheted up the tensions, the rhetoric, and the threat of export controls on, in China's case, with their rare earths, and in the U.S.'s case, with high-tech exports to China. So those talks are going to play out over the weekend. We've seen a pattern where they escalate the rhetoric, and then they reach some sort of deal, and they push back the next deadline another 90 days. That would be sort of the base case scenario that you could expect out of this. But there's a lot at stake, and China has realized that it really has a lot of leverage with these rare export controls that it can apply to the rest of the world.
You know, I was thinking about these rare export controls. They didn't exist before this trade war was started. Rare earths flowed freely, and soybeans also is a product that the Chinese bought a lot of before this trade war was started. In fact, almost $13 billion worth of soybeans from the U.S. last year. So is a win here just sort of reversing the damage that's already been done by this trade war?
Yeah, exactly. I mean, something like getting China to purchase American soybeans again is not really a win. It's just kind of restoring what has been happening all along. And the same goes with rare earths. China knows it has a lot of leverage here. The U.S. is trying to rally other countries, from Canada to countries in Europe to Australia, to try to push back against China's leverage on this. And it's yet to be seen whether that will have an impact. But China is definitely going into these talks feeling like they have the upper hand, whereas when they started off in May back in Geneva, the U.S. felt like it had the upper hand. So we've really seen the tables turn over the past 5 months.
All right, Brendan, great to get some time with you. Really appreciate it. Bloomberg's trade czar, Brendan Murray, coming to us out of London. Now, quick check on what's going on with futures ahead of the opening bell, as CPI came in a little bit lighter than expected. We were looking for 3.1%. We only got 3% even on the headline and the core. So as a result, traders pricing in more rate cuts, and futures rallying right now 0.6% on the S&P.
A look at some of the other movers on our radar this morning. GM laid off about 200 salaried employees just days after raising its profit guidance. The firings were due to business conditions, they said, and not their performance.
Target will eliminate 8% of corporate roles, about 1,800 positions, through layoffs and closing out open roles. Booz Allen, I guess, is actually down. The shares are down after the defense contractor cut its adjusted earnings per share guidance for the full year, and as a result, those shares are off more than 10%.
Now, coming up, Emily, Bowersock Hill says overvaluation by itself rarely triggers a stock market correction in 2025. The same goes for government shutdown, trade upheaval, or credit market worries. We're going to discuss what it would take to slow the bull rally. That's coming up on Bloomberg TV.
The Fed's going to keep on cutting rates. It's generally a better than expected report, but I think what it really shows is we have a K-shaped economy, and it's sort of a K-shaped CPI report. The thing that really jumped out at me is, first of all, rental costs coming down. There's, we've got a big change in demographics here, and rental inflation is just going away. You also saw used vehicle prices fall. I thought that was pretty interesting.
JP Morgan's chief global strategist, David Kelly, speaking earlier on Bloomberg Surveillance after an inflation print that came in lower than expected. Let's bring in Emily Bowersock Hill of Bowersock Capital CEO. Emily, really great to see you this morning. And there you go. One risk event out of the way. We got CPI coming in less than expected. Next up, we have tech earnings. We have a meeting between President Xi and Trump. Do any of those risk events, do they seem like it could derail this rally, this ride that we're currently on?
The momentum behind this rally is very strong, and the market seems basically impervious to bad news. DeepSeek, Liberation Day, cracks in the credit market, a government shutdown. So I think what it would take to derail the market at this point would be something really unexpected and surprising. I don't think it's going to come out of the meeting with Xi. I think the markets have just stopped listening to the tariff vacillations coming out of the administration.
What about earnings? How do you see the third quarter going so far?
I do not see earnings disappointments significant enough to derail the market momentum. I think we're probably not going to see. I think the next chance, frankly, for a very significant market downturn, and this is notwithstanding some minor correction, which is certainly possible before the end of the year, is going to come in first quarter earnings of next year, which is going to report how things went during the retail season. We've got three very significant sources of stimulative spending coming into this economy. And the first one is well talked about. That's the spending on AI. The second is consumer spending, which while it's not high by historical standards, it's certainly stabilized after the second quarter. And the passion of the American consumer for spending is unmatched. The worse their mood, the more they spend. The better the mood, the more they spend.
Yeah.
And we're seeing the spending coming from those higher income Americans that seem pretty insulated from price change.
So, Emily, we'll get more into some of those individual earnings and the spending coming up. Emily Bowersock Hill is going to stay with us. Coming up next, it's your Market Open.
All right, moments away from the start of trading on this Friday, and it looks like we have a rally on our hands, potentially new record highs on equity indexes today. S&P futures up 0.2%, NASDAQ futures gaining almost 0.9%. In terms of the bell ringers, we don't have a lot of substantial historical performance to look at. Grayscale ringing the bell at the New York Stock Exchange. Speaking of crypto, just working its way into traditional financial structures. They're putting out an ETF that now has multiple different crypto kind of coins in it. Who knows? And then down at the NASDAQ, AXG, I think it's SolarWinds or something, but if you look at the performance, it's like done nothing forever. So there are stocks that are important for us to watch and take note of and are doing things, and you've got one on your board there.
Yes, and if we keep at this pace, Matt, I have Intel. It's going to have doubled, or just about doubled, for the entirety of the year. What a wild ride this company has been on. Shares are up 7% here at the open. Their turnaround plan, it's showing signs of progress. They've returned to profitability. Intel also gave an upbeat revenue forecast because it sees a rebound in PC demand, Matt.
All right, and speaking of rebound, Ford plans to build 50,000 more trucks at factories in Michigan and Kentucky in 2026, recouping about half the production it expects to lose this year as a result of a fire at the Novelis aluminum factory here in New York State. As a result, Ford is up more than 3% because it looks like the market expected worse and is happy to get some guidance. Ford shares actually doing really well this year. They are up 29% year to date, really neck and neck with GM, which has just really broken out this week, also up, but only 27%.
President Trump taking credit for it, saying that GM and Ford are up big because of tariffs on foreign trucks.
Yeah, they don't mind that they're going to have to pay billions or multiple billions of dollars in tariff bills, and maybe the Supreme Court reverses that, and then they'll be up even bigger. Let's bring back Bowersock Capital CEO and founding partner Emily Bowersock Hill. I guess that's kind of the story of this market, right? Things could have been so much worse, but is that really reason to rally this far, this fast?
We're deep into the greed phase of the fear-greed cycle. And so there's a lot of FOMO going on. And I think that the momentum is very significant. So frankly, I think that as long as earnings overall don't really unexpectedly surprise investors, I don't see earnings themselves being a reason for a major market setback. And frankly, Intel's earnings and the earnings by Lam Research earlier this week, both of which are AI-related tech names, surprised on the upside. And I think we may see more of that.
I was reading some research from Citrini Research that's done a really excellent job on capturing the AI trade. Emily, they wrote over there something that has been a relative comfort in being able to stay long despite calls for an AI bubble so far has been the fact that most of the CapEx has come from cash and cash flow. You don't have a bubble until the majority of the expansion is done on debt. I bring that up because we have coming into the market $38 billion worth of Oracle coming in to secure financing for a data center that they're building for OpenAI. Does the use of debt concern you from these tech giants?
You are right that until very recently, the AI spending was funded by free cash flow. And now the Fabulous Five are starting to take on debt to do this. I think the most analogous recent period in history that I'm looking to is the telecom boom. And the real build out was 1997 to 2000. A lot of that was debt financed. And so, yes, it does concern me that debt is now part of the equation. But I still think that if you look at where we are versus that telecom boom, we're still a couple of years, 1 to 3 years away from that coming to an end. I think debt is one indicator that we're getting closer.
What do you like right now outside of growth? Or let me put that a different way. Do you see value that's worth buying in this market, Emily?
Yeah, it's tough. It's tough right now to put cash to work, and it's definitely tough to chase these tech names if you don't already own them. We like financials because I think they will benefit from deregulation. The capital loss requirements have significantly loosened, and most of the banks have not taken advantage of that yet fully. And earnings last week, I think, were a good indication that that things are looking good for financial institutions generally. I think they will benefit from the adoption of digital payments over the next 5 to 10 years. So you have a little bit of an AI boost and some productivity boosts that are going to come from AI and AI spending. So I think generally financial services are probably still at a good value.
We've seen some stocks get clobbered as a result of the one big beautiful bill, but you note that there were some real tax advantages there for certain businesses. Is there an investment case to be made because of some of those changes?
Yes, I think I mentioned previously that I mentioned two sources already of stimulative spending that are going into this economy. The first being AI spending, and the second, higher-end American consumers. The third is that the tax legislation put new depreciation rules in place, which provide a very strong incentive to finish construction, capital spending projects by December 31st of 2029. So there is a rush to start these projects and finish them within 3 years. And that is also going to inject more stimulus into this economy.
Emily, it's an interesting environment because you have that at the same time that you have Trump sparring with Canada over trade talks, with trade talks on deck for China. From Bespoke, they said companies so far on their earnings calls are avoiding mentions of negative macroeconomic headwinds on their earnings calls. Are you surprised that more of corporate America isn't citing this macro environment, or has it just become all the more friendly for them?
I think there's a certain amount of fear out there. I think people are trying to avoid any kind of statement that could be construed as political. Why do that? Why put your head up above the parapet? And so I think it's probably prudent on their part. I think it's unfortunate because I think what we need is transparency and communication, and we want to hear during company earnings what people think about the macro environment and what they're concerned about. But I think we're getting less of that disclosure, frankly.
You mentioned that we're in the greed stage and that we could have, if you look at the parallels of AI to the telecom boom that we saw in the late 90s, very early 2000s, maybe a year or two left. In October of 99, as we've heard a few times from Paul Tudor Jones, we still had a doubling of the NASDAQ before March of 2000. Do you think that's the phase that we're in right now?
I don't think we're quite there yet. When you look at infrastructure booms in history, so take the railroad boom in the 1840s in Britain, which was real, right? It went from taking you 4 days to get from Manchester to London to taking 4 hours. And it peaked at 7% of GDP in terms of spending on railroads. We're now at about 1 to 2% of GDP, which is very substantial. And in the first half of the year, it actually was a bigger part of GDP than consumer spending. But I think there's probably still some room to run on it. I think there's some massive misspending going on. No doubt about that. We are in a bubble. The question is, where is the misspending? And when are we going to find out what it is?
I talked to an executive who said we're putting data centers on the moon, so I definitely feel some of that kind of froth coming in. Emily, it's been such a joy to have you. Please come back and join us again soon. Bowersock Capital CEO and founding partner Emily Bowersock Hill. A check on your equity market. We are nearing 6,800, and if we close at these levels, we will be at another record high. All we had to do to get there was go up 1/4%. We are up more than 0.8%. So yeah, we got there. The CPI report comes in 0.2% for core. The expectation was for 0.3% month over month for core. And what does that do? That gives you a boost to your tech stocks. NVIDIA, the biggest mover by market cap, followed by Broadcom, Alphabet, Amazon. If you're a Mag 7 holder, it's a good day for you for everything except your Tesla in your Mag 7. Tesla, a crazy day yesterday. They had earnings that disappointed, despite the fact they had record EV sales. Tesla opens up sharply lower yesterday and ends the day higher. It is lower yet again, some real volatility. Newmont, one of the worst performers too this morning. They said that they're not going to be spending as much as the market had hoped on new gold mining operations. A disappointment there. Netflix down incredibly sharply, it would appear this. Oh, sorry, I'm looking at Deckers.
Yeah,
Deckers is down
I was gonna say.
14. They're close to each other. Deckers is down 14% because no one wants to buy Uggs and Hokas. Netflix, though, Matt, I did have bad earnings, so I'm not totally without reason flagging Netflix. Just a quick look at some of the sectors. Most of them are in the green today. Again, it's the macro story of CPI allowing the Fed to cut. Infotech, that is number one, followed by financials and communications. Materials, the only sector lower, Matt.
I'm going to push back on the Hokas because
yes.
My former co-anchor, Katie Greifeld, who now co-anchors The Close with Romain Bostic, she buys a new pair of Hokas like every 6 weeks.
I guess that's not enough to support them because they didn't have good earnings, Matt.
I'm going to tell Katie to step it up.
More Hokas. Maybe she needs to start buying Uggs too. Maybe that's the problem.
Yeah, I wouldn't put it past her, frankly. I could see that being the case on the weekends. Coming up, Ugg and Hoka maker Deckers. We're going to talk more about this. Absolutely pummeled. You can see this chart year to date, losing more than 50% of its market cap. This company, it's been a tough year for shareholders. We'll explain when we come back. This is Bloomberg Open Interest.
After a cooler than expected CPI, we are just under 6,800, easily a new record for the S&P. If it hangs tight, the NASDAQ, that outperforms not only because of the CPI coming in cooler, but also Intel earnings. Some of your top calls this morning, the analyst action that we are focusing in on. Coinbase, that gets an upgrade at JP Morgan. They cite reduced risks, fresh monetization prospects, and the company will report earnings next Thursday. Next up, Stifel, they downgrade Snap to a sell ahead of a third quarter earnings. They cite tougher year-over-year comparisons and still macro uncertainty. Stifel says that sentiment from advertisers is also worsening with more risk to the downside. The market doesn't care, though, because everything is rallying today, except for Deckers. UGG maker Decker Outdoors gave a weak forecast for 2026. Analysts, though, do say that the outlook may be conservative given ongoing strength at Hoka and UGG. Its price target, though, was cut at Bernstein and a handful of other firms. Those shares getting crushed, Matt, down 13.25%.
Yeah, let's discuss Deckers further with Bloomberg retail reporter Lily Meyer. And I had a buddy in town, an old hippie friend from Boulder, and he was wearing Tevas. And I thought, this has to be the last guy on earth who's bought Tevas. That's the other big brand that they make. Hoka, Uggs, and Tevas. It's not going well, is it?
Yeah, I mean, I hate to share this, but I do own a pair of Tevas.
Nice.
But, you know, I think with earnings, the stock really dropped on their guidance, and I think they are really expecting consumers to begin to feel that tariff impact.
How much of that, though, is just a one-off, Lily? Because there's Deckers, and then there's P&G, showing up really strong earnings that people are willing to pay up for a brand name.
Yeah, so P&G actually cut the tariff impact, and a lot of that was on Canada getting rid of their retaliatory tariffs. And they also said they're seeing consumers trade up. So, you know, we're going to have to wait a little bit and see what other companies report, but they kind of had different outcomes.
Right. I mean, one is really a consumer staple. You have to, if you're a slave to the Gillette razor machine, continue to buy those replacements.
You could buy like a white label razor, though. You don't need to buy the Gillette branded.
I'm going to say, if you've gotten into the Mach 16 or whatever it is now, you just can't get out of it. It's a tough cycle to break. And then, obviously, a toothpaste or washing detergent, you're not going to stop buying that, and you're probably not going to switch down. You're more likely to save money by not buying a new pair of Uggs, right?
Yeah, I mean, I guess it depends what your calculation on that is. But yeah, I mean, grooming was one of the areas that they saw a lot of success in, as was beauty and personal care.
All right, so they're still doing well. We still want to look good, you know? And
at least
here's the fun thing, right? Part of looking good is a Gillette razor and Tide detergent.
Are you getting
Part
paid by Gillette? What's happening, Matt?
Is not UGG. No, I'm just saying, like, as you know, I like the Japanese double-edged safety razors.
Yes.
Feather. It's a very good choice. Buy now, buy once, cry once, you know? But I'm just saying, if you're in the cycle of Gillette,
right,
you
can't get out. You're stuck forever.
No one's buying the Wilkinson swords, right?
I have no idea what that is. Sounds great.
All right, Lily, thank you very much. Bloomberg's retail reporter, Lily Meyer there. In other news, Intel's CFO says demand is outpacing supply as the company returns to profitability and gives an upbeat forecast. The stock has been hot this year. Bloomberg Tech's co-host, Caroline Hyde, joins us now. So this company getting an absolute mega boost from President Donald Trump.
And from NVIDIA. And from SoftBank.
Well, because of President Donald Trump.
And it's about $16 billion of money that either is a stay of execution or actually can reignite real growth once again. Because let's face it, yes, they returned to profitability, but it's been about 6 straight quarters where they didn't have profits, and we're actually still leaking out only 3% revenue growth. At a time where we're meant to be seeing CPUs a delight within the AI data center space, as well as GPUs. They did see more demand than supply. They are seeing a demand really for the next generation of chips that go into PCs in particular. Maybe the AI PC is starting to take off, when we're really starting to see people wanting to be upgrading with the new Microsoft Windows as well. So they did see some stronger overall fundamentals for this business. But the stock is up 90%. Most companies that analyze this stock, so most of the overall analysts that are on it, are saying, look, you should either hold or sell from here because the upside is still so much hinging on whether they can compete with TSMC. Are people going to eventually want their chips fabricated by Intel in the United States? What types of chips? What margin are they going to make on it? What sort of actual good chips are we going to be getting out of these ones that are manufactured when you're looking at the 18A, not to mention 14A, which is the next iteration of chip that at the moment, Lip-Bu Tan, the new CEO since March, has been saying, I'm not going to build it unless they definitely come, unless I know I've got the demand. So we're in this kind of catch-22 situation.
Caroline, I can only imagine how insane your week is going to be next week on Bloomberg Tech. It's all the rest of the big cap tech. Microsoft on Wednesday, then Meta, then Alphabet. You also have Amazon and Apple coming in on Thursday.
It's a party.
Yeah, I mean, is it, or is it like a hold on to your seats and pray that they keep the rally going?
And I think this is what, for most investors, is the question. Are the fundamentals there to keep on pushing up these valuations? And I think from what we've got so far, the hints are that, yeah, people are actually committing real money into real revenue-generating businesses. Whether or not we'll see the advertising momentum still carry on for Meta, whether we see Microsoft still managing to cash in on Azure and seeing with an uptick. Look, we've had a big deal for Alphabet's new chips coming from Anthropic. What does that mean for Google's ability to outperform when it comes to Gemini demand? More broadly, for the advertising to remain sticky. A lot of these businesses need the economy to keep on growing too. But I think thus far we have managed to see fundamentals bear out in a lot of the growth stories for these companies. The valuations on these companies, unlike Nvidia, which trades at 60 times future earnings, Nvidia is much healthier because earnings have risen at the same pace as the shares have more broadly as well.
Wow, no, Nvidia trades at 41 times future earnings.
It's not as bad.
60 would have been a huge jump, I think.
That's Intel.
You're thinking, well, and Costco, right? I mean, some of these companies are trading at huge. Okay, Costco's 47 now, but
Microsoft, Meta, some of the other numbers seemingly in line with where the Nasdaq generally performs. People feel that they're not too expensive.
Yeah, no.
To currently stay.
It looks cheap. 33 times. Microsoft is 33 times earnings. I love to go through these estimated PEs. All right. Caroline Hyde, looking forward to your program. She co-anchors Bloomberg Tech with Ed Ludlow. Coming up, Goldman Sachs is launching a new ETF.
Yeah, and it's an ETF that's designed to mimic private equity returns. How are they going to do that? More on that coming up next. You're watching Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on in stocks. Just about 23 minutes into trading right now at 67.92. We are at an intraday record, and if we close anywhere near here, we'll be at a closing record as well. So the market continues to march to new highs today on optimism, really that President Trump and President Xi at a meeting will finally deal somehow with this trade spat. NASDAQ gaining 0.9% as all of the Mag 7 stocks, really, other than Tesla, are rallying. Dani showed you that just moments ago. Take a look at some of them here. Nvidia up almost 2%. Intel up 3.4%. We just talked about with Caroline Hyde. Next week is massive for tech earnings. I think 27 trillion. Is that right? $27 trillion in market cap reporting next week.
Yeah,
and then
sounds about right.
Look, what are we going to need in order to make the AI bubble work? It's going to be power. So Oklo up another 8% today. Grindr, I have no idea what's going on with Grindr, but it's being taken private here, and I wish those gentlemen luck. Up 26% and change. Newmont Mining down as gold continues to retrace its spike higher, and then Cipher Mining up 10% today. Dani?
I do want to confirm you are right. 27 trillion next week. It was 9 trillion this week. Elsewhere, Matt, Goldman Sachs joining the growing list of managers looking to replicate private equity exposure with an ETF. The only other one is Apollo doing credit. I spoke to Michael Brunn, global co-head of private equity at Goldman Sachs Alternatives, on the activity he's seeing in private equity.
We certainly think that deal-making volumes are back for very fundamental reasons. First of all, private market valuations have stabilized. At the same time, you've seen volatility come down, and importantly, you've seen base rates reduce and credit spreads reduce. We certainly see it as a more constructive environment, and we certainly think that that backlog will allow for a lot of interesting deal formation on the buy side.
GSAM's Michael Brunn there. He says private equity is doing well, and apparently Goldman agrees and thinks everyone wants exposure via their ETF. But they're not buying private companies, they're buying public companies, which begs the question, if you can make an ETF with private capital returns via public companies, why would you ever invest in private equity to begin with?
It really is pretty confusing when you think about it that way. And Goldman Sachs said that they're doing this because so many investors want private equity exposure, but this isn't that.
Right.
So they should say they're doing this when so many investors want private equity returns.
Right. But again, their thing is they can create private equity returns in public markets, which I think is against the whole point of it. Anyway, another hour of Bloomberg Open Interest coming up next.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. We are trading at all-time highs yet again. after a little bit of CPI data.
Yeah, we continue to rally after the first major data release since the shutdown. U.S. inflation rose less than expected in September, keeping the Fed on track to cut rates.
But then there's the latest tariff twist. President Trump terminates trade talks with Canada as he gears up for a meeting with China's Xi next week.
And the busiest week of earnings is imminent. Nearly $27 trillion in market cap reporting next week with the Mag 7 leading the charge. We have some breaking economic data I see rolling across my ticker right now. University of Michigan, the final reading for October consumer sentiment falls to 53.6. The estimate was for 54.5. We have Michael McKee here with us on set, Bloomberg's international policy and economics correspondent. So is this a case where above 50 is expansion and below 50 is contraction?
Yeah, although we're getting close to the line at this point with the headline number. The current conditions index falls to 58.6 from 61, and expectations drop to 50.3 from 51.2. So people getting closer to the idea that we may see some sort of slowdown ahead. It's not particularly good news, but it's not going to be outweighed by, it's not going to outweigh the CPI. Speaking of inflation, the University of Michigan's 1 year ahead inflation index unchanged at 3.6%, while the 5 to 10 year number, which Fed officials look at more closely, 3.9%, up from 3.7%. So there are some longer term inflation questions out there. You wouldn't want to say that maybe we are at this point unanchored, but we're definitely seeing some concerns. And of course, with CPI today, we got to 3% on both the headline and the core for the annual rate, which is not the 2% that the Fed is looking for.
It's only 50% above their target.
It's only 50% above their target.
What's 50% among friends?
And of course, the news that captured everybody's attention came out shortly after the CPI report, with the White House sending out a tweet that suggested we will not get an October CPI report because it's too late now to collect the data. Now, the Bureau of Labor Statistics hasn't confirmed that, but that seems to be the view, that we're now far enough into it that we won't get a report. And so the Fed is going to be flying blind when it comes to the December decision to make.
Well, here's someone that's confident. The NEC's director, Kevin Hassett, saying inflation numbers were fantastic, so he doesn't seem too concerned. Mike, thank you so much for joining.
Not only that, Presidents Trump and Xi are great friends, according to Kevin Hassett.
Ah, okay. And according to President Trump, the car makers are very happy about tariffs, so everything is sunny and fantastic.
They love them.
They love them. Let's see if our next guest also sees the world sunny and fantastic. It's Marija Veitmane, State Street Global Markets Head of Equity Research. And Marija, I know for you, the only game in town is tech. If you are very long tech, today is a great day for you. Those shares are outperforming. Does it continue into the earnings next week?
I mean, we'll see next week. But I mean, so far, the kind of the read across we heard from kind of other companies is that supply is smaller than demand, and there is kind of lots of upside for kind of order books in lots of tech companies. So yeah, no, looking quite optimistic about next week.
What do you? I mean, this gets beyond next week's earnings, and you have great reason to be optimistic that the big tech companies will deliver. But if you look longer term, what do you think about the power demands that are necessary to run all of this sort of pie in the sky, AI dream? Is it going to happen?
We'll see. Technology is developing. AI is getting. We know Moore's law. We know that computers get more efficient. So, I mean, potentially, yes. But so far, we haven't seen kind of the sticking point. So far, we haven't seen kind of big issue. But I think in terms of kind of AI investing, so what investors should be looking at, and that has been a kind of a real big topic for us, is that what else other than tech? So where else can you go? Okay, there are lots of concerns about AI and bubble and like you might your issue with power, absolutely. But where else can you go? And that's a really sticking point for us. We really struggle to see other alternatives for investors to get into, and that's really kind of a big reason to stay with AI.
Marija, I asked Emily Bowersock Hill in the last hour about this idea that was brought up by Citrini Research, that the reason you could initially be confident about the AI trade not being in a bubble is that it was being funded by cash flow of these tech giants. that's changing. Oracle is a great poster child of that, putting another $38 billion, securing that of a debt deal to finance the AI build out. Does it concern you that more debt is being used?
Absolutely. I mean, particularly for Oracle, that's a concern. I think that's not generally true. I think there are lots and lots of companies that still have enough cash flow to be able to finance their deal. I mean, Nvidia is a good example of that. That means they're getting involved with lots of their kind of consumer, but equally they have kind of a lot of money to invest there. Microsoft. So I think it's something to keep an eye on, something to be concerned about, but I don't think that's kind of systemic problem yet.
We're talking about Kevin Hassett's comments. He was on Fox saying that Presidents Trump and Xi are great friends, and that there's been some thawing in recent days of the coldness of that relationship since President Trump started this trade war. Or I imagine they would say, the Chinese started it long before that, and they would have a fair point there. But the point that I want to get to is these rare earth minerals are so important to everything that the U.S. makes in terms of consumer products and the world makes in terms of consumer products, but especially the AI boom. How come the bulls seem so confident that we're going to have this dealt with?
I mean, another good question in terms of kind of thinking about like AI case. I mean, in general, I would probably suggest that both U.S. and China need to cooperate. I think it's in both economies' interest to have a decent trading relationship. And I mean, it's a big negotiation, and as I said, it's in both interests to find some deal and to find some compromise. I mean, China needs a lot from U.S. needs a lot from China. It's potentially, to me, that sounds like it's in both economic interest to cooperate and find the deal. And I think that's kind of what gives markets some comfort in terms of there is economic interest there.
Marija, in the first half of this year, when companies were dealing with tariffs, we saw a lot of front running, and it didn't seem like you saw the impact yet. We're starting to hear from companies. It was Tesla and Mattel earlier this week that said that they are seeing an impact. Deckers, the maker of Uggs and Hoka, said that consumers weren't buying as much because they were starting to feel higher prices because of tariffs. Is this the tariff impact finally coming home to roost, or is it just companies using it as an excuse for otherwise low demand?
Yeah, no, I think there is truth is usually somewhere in the middle. I think what we kind of keeping a close eye on is margins. So ability of consumers to pass margins to, or ability of companies to pass margins to their kind of end consumers. And what I find quite interesting is that when we look at State Street custodial database, what we see is institutional investors are heavily positioned toward sectors with higher margins, so higher ability to pass, to kind of navigate those kind of higher input costs, and they're really underweight sectors with lower margins. And I think that's kind of telling that, yes, investors are somewhat concerned about kind of trade war. I mean, you can dress it up as margins, as higher costs, maybe kind of some stagflationary pressures, but we definitely see investors kind of being cautious about it.
Marija, we have a lot of investors on who love tech, and you have for some time. So you've done well, your clients have done well. But if someone comes to you with new money, do you buy that tech now at these valuations?
I mean, yes, I do. And I think the main point for us is that what else? What else can you go? Where can you go to? And as we said, I mean, look at where the earnings growth is. Earnings growth in kind of Q3 or full year earnings in tech is 3-4 times higher than X-Tech. Look at margins. They're like about 4 times higher than outside tech. So, and as you say, if new money coming in, they need to be allocated somewhere. And what investors really want to allocate to is some kind of earnings stability, earnings predictability, earnings resilience. And that's tech. It's not small caps. I mean, if you look at small cap margin expectations, they keep going down, down, down. If you look at value stocks, again, you see margins construction. And I think that's really important point. Is that where do you see quality and stability, and it's still large cap tech.
All right. Great to get some time with you, Marija. Really appreciate you joining us. Marija Veitmane there of State Street talking to us about what stocks you buy even today. Let's get a check on the markets. We are looking at an all-new intraday record. We could hit 6,800. I wouldn't put it past this market by the end of this Friday. On the S&P 500, the NASDAQ up more than 1%.
Some of the single stocks that are also moving this hour, helping the NASDAQ this morning. Intel shares, they are rising. The chipmaker has returned to profitability and gave an upbeat revenue forecast. Then there's Deckers. It makes Uggs and Hokas. It is plunging. 2026 sales look weaker than anticipated. Analysts say it might be a conservative outlook. Shares are down 14%. Meanwhile, on the other side of consumer goods, P&G sales topped estimates, led by beauty and razor products. It maintained its outlook for the fiscal year.
Coming up, Argentina's President Javier Milei facing a pivotal moment with midterm elections on Sunday. We are live in Buenos Aires next. This is Bloomberg Open Interest. Let's get to high interest now. A look at what's making headlines around the world. President Trump abruptly scrapped plans for a peace summit with Vladimir Putin and imposed new sanctions on Russia after the Secretary of State Marco Rubio warned Moscow was stalling. Rubio, along Russia hawk, called off his own meeting with Sergei Lavrov, arguing Putin hadn't budged on Ukraine. The move cements Rubio's growing sway inside of Trump's foreign policy circle. And Zoran Mamdani, the frontrunner for New York mayor, is pitching a plan to overhaul the city's tangled permitting system, cutting fees for small businesses and nonprofits and scaling rules to event size. He says the goal is to make it easier for New Yorkers to host block parties and celebrations around New York's FIFA World Cup, part of a broader push to cut red tape and restore faith in city government. President Trump is campaigning hard against Mamdani. And Argentine President Javier Milei will meet JP Morgan CEO Jamie Dimon in Buenos Aires today ahead of Sunday's pivotal midterm vote that could decide the fate of Milei's market reforms. The talks come as the U.S. Treasury backs Argentina with a $20 billion swap line and another $20 billion in private financing. Dimon's visit, planned before the recent turmoil, includes meetings with CEOs and an expansion push in Argentina.
Let's stay with the country. And we spoke earlier in the week with Gustavo Medeiros, head of research at Ashmore Investment Management, on the state of play heading into this weekend's election.
The toughest part of the job, Javier Milei has already done. There has been 2 years that he's done the most aggressive fiscal consolidation of any G20 countries that I've ever seen in 25 years of investing. So I think that people are making, this is Argentinian elections. There has to be some drama, but people are making a bit of much bigger of a drama than it should have been.
Joining us now live from Buenos Aires is Patrick Gillespie. He is Bloomberg's Buenos Aires bureau chief. Patrick, what is at stake for the elections?
Good morning from Buenos Aires, Matt and Dani. So there's a lot going on in these midterm elections on Sunday in Argentina. This is really going to be a referendum on Javier Milei's economic policies. Beyond the relatively low-profile candidates that are on the ballot, you could really argue that, in effect, voters will also be casting ballots for Milei's pro-market economic agenda, his austerity policies that have really had a major impact on the cost of living here, and of course the $40 billion rescue package from the Trump administration that President Trump himself has conditioned on Milei's party winning this midterm election on Sunday. So really what was a relatively normal midterm election heading into this race has turned into something that's really going to be a make or break moment for Milei's policies and this rescue package from the U.S.
Well, and I mean, I was listening to Greg Makoff on Odd Lots. He wrote the book Default, the landmark court battle over Argentina's $100 billion debt restructuring. And he painted this as a make or break moment for the country, saying that this is, the people's chance to vote for whether or not they want to continue reforms and fix the problem that has so long dogged Argentina, or just go back to the cycle of, devaluations and defaults. Do you see it that way as well?
Well, clearly, fiscal deficits have plagued Argentina for years because it's resulted in high inflation, deficits, and eventually sovereign defaults. So Milei has tried to address the root problem of so many of Argentina's crises, but it's painful. Austerity is painful. If you think about the ordinary Argentine, utility bills have quadrupled in the last 2 years. So salaries have not kept up. Economic activity is losing momentum. Retail sales have been down for 6 straight months. So we are seeing the economic impacts of harsh austerity policies, but they have achieved much lower inflation, much lower poverty. So it really is, there's been a lot of risk and a lot of reward, but voters are losing patience, it seems, with Milei's austerity.
So how much does a $40 billion rescue package from the United States of America change the game, Patrick?
Well, I think it's really interesting, Dani, in the sense that, there's a $20 billion currency swap line that the U.S. and Argentina have signed. We haven't seen it put into action yet. There's also the U.S. is trying to line up about a similar amount, another $20 billion in Wall Street financing. And really the most interesting pillar of this rescue package so far is that the U.S. Treasury is buying Argentine pesos. They've been doing that almost every day for the past 2 weeks. This is coming after Milei, who campaigned as a president on dollarizing Argentina, has now convinced the U.S. to buy Argentine pesos. This has helped to be somewhat of a temporary, short-term support for financial support for Milei. But the U.S., Argentina has a long history of Washington bailouts, whether from the U.S. government or from the IMF. And I think there's a lot of weariness because they usually come with concessions that aren't revealed in the beginning. And we still don't know what concessions Argentina has made in exchange for this extraordinary support from the U.S.
A long history a long history, Patrick, of corruption as well. What role does Milei's sister play in this election?
Well, certainly, I think another issue that's disappointed voters is that Milei came into office with this outsider image, and so far this year, Milei has faced 3 corruption scandals. There was a cryptocurrency scandal earlier this year. His sister is facing bribery allegations, and Milei's top candidate had to drop out of the race just a few weeks ago because he had ties to a drug trafficker that is now being extradited to the United States. So Milei's Drain the Swamp image and anti-corruption sort of campaign has really been dismantled because of these corruption scandals. And I think that's definitely going to have an impact Sunday in the polls.
Patrick, great to get the update with you. Bloomberg's Buenos Aires Bureau Chief Patrick Gillespie talking about the importance of the election this week. And, of course, we're going to bring you those results on Monday. Turning back to the U.S. now, President Trump heading to Malaysia tonight to kick off his Asia tour, where he is set to meet with Chinese President Xi Jinping on Thursday in South Korea. Let's bring in Bloomberg senior editor Michael Shepard. And Shep, it's interesting, the main goals, as far as I can see it, are getting the Chinese to buy soybeans again, which they did in size before President Trump slapped tariffs on them, getting them to freely sell rare earth minerals, which they did before President Trump slapped these tariffs on them, and getting them to cut off the flow of fentanyl. It seems like that would be really the only win here. Am I missing something?
No, I think you've really sized up Trump's demands heading into the meeting, and he really hasn't brought up much at all the question of shipping and all of the other thorny issues on trade that really remain between the world's 2 largest economies and that would need to be resolved in a far greater bargain or deal than what we would expect to come from any talks that we have between the 2 leaders, Trump and Xi. We are expecting Treasury Secretary Scott Bessent and his Chinese counterpart, He Lifeng, to be meeting coming in the next day or so in Malaysia ahead of this leaders summit to try to hash out some of the issues you just brought up, Matt. The biggest one, though, is the rare earths. That really hit a nerve here in Washington with officials. They had thought that this had been resolved in previous rounds of talks, and they were a bit surprised to see China reopen it by imposing these curbs. And remember, these curbs are going to have a wide-ranging impact on a whole host of industries, from autos to consumer electronics to defense. And it is something that the U.S. would really want to see resolved. And more broadly, Matt, the U.S. wants to see a reduction in some of these trade tensions. It is weighing on the economy and on decisions by companies and businesses. And that in itself, for both sides, really, as your guest from State Street pointed to, both sides would really like to see some cooling of the temperatures in the room.
Hey, Mike, just about 45 seconds here, but the Wall Street Journal had reporting that she noticed the market chaos and thinks that D.C. can't stomach economic pain. Who holds the cards?
Well, it's a great question because, many people have pointed to China in this case now holding leverage in the talks because of its hold on the rare earth supply. It has more than half of the world's proven reserves. It dominates the production and refining of rare earths, and that is a key bit of leverage going into these talks. And it also is one of the world's top shipbuilders. Again, another advantage to China. But we also have to look to see what the U.S. brings, and that is a market that China would very much like to sell into.
All right, Bloomberg's Michael Shepard there in Washington. Really looking forward to our political coverage. Balance of Power kicks off at noon today on Bloomberg Radio at 1 o'clock on Bloomberg Television. Still ahead, Ford delivers better than expected earnings. We'll bring you my exclusive interview with the CEO, Jim Farley. This is Open Interest. Hey, should we check on the markets?
Sounds like a great idea.
Let's do that. Right now, we're looking at 67.93 on the S&P 500. We could hit 6,800 today. I almost said 8,000.
That would be wild. We did hit 6,800 for like a second, and then we pulled back off of it. Still, we are easily at a new record.
So big rally today, but I'm excited about something else.
Please do tell.
We have the CEO of Scout Motors coming on. Scott Keogh is going to join us to talk about the relaunch of an iconic vehicle. Scott Keogh, Scout Motors president and CEO. I've actually reserved one of these, full disclosure, and we'll get to it next on Open Interest. Exactly 1 year ago, Scout Motors announced its return, with parent company Volkswagen naming Scott Keogh as CEO. Since then, the company has pivoted from plans to produce only battery electric vehicles, adding a gas motor hybrid to the lineup, which now dominates pre-orders. Today, Scott comes back to Open Interest to give us an update after announcing an additional $300 million investment in his $2 billion South Carolina plant. Scott, great to have you on the program. I have to say, we told our automotive team on the BN side that we were having you on, and we were flooded with questions. Everybody wants to know about Scout, from Keith Naughton to Craig Trudell to Monica Raymond. The list goes on and on. I especially am interested, as you know, I put in a reservation, and I actually reserved the full BEV version, which is, I know, unusual since I'm normally a V8 guy, but are you still going to be making that one at first, or will you go just with the hybrids at first because you've had so many more orders for those?
Look, Matt, that's a fair question, and we're developing both of them, as you know, and we're developing them parallel. Look, the market has spoken. Over 80% of the reservations are the range extender. In general, in life, you like to meet the market. So certainly we would probably lean with the EREV, but nothing we've announced yet, Matt. Both of them are being developed. Both of them can be handled at the manufacturing line, as you know, down in Blythewood. We'll announce that as soon as possible. I know I have to tell you first, since you're a reservation holder.
I'm waiting. I mean, there are a lot of reservation holders. How many of us are there so far?
There's over 130,000 the last time I checked, and growing each and every day. So it's really exciting. The demand for the car is phenomenal. It's one of the best responded to products I've seen in my 30 years in the automotive business here in America. So we're obviously excited.
I wonder about the production facility. I'm really psyched to go down there and check it out when I get the invite in Blythewood. I guess you can make up to 200,000 a year. Are you going to be running it at full tilt, or what's the idea in terms of capacity utilization?
Look, you know the dream, Matt. The dream is full utilization, and full utilization is, 3 shifts, 24 hours a day, 7 days a week. That's the dream. And but look, we want to get there, and we want to make sure we can ramp up with maturity. So we think it'll take at least 3-ish years to get to that full output, because we want to make sure the product is right, the quality is right, everything is dialed in, the employees are properly trained. But that's the dream. Full utilization is exactly how you get maximum profitability, and that's what we want to work towards, and we feel confident we can get there.
It's a lot of building you're having to do, Scott, because it's not just the factories. It's the fact that you're going direct to consumer, which takes a lot of support. It takes a lot of service and some real investment in that. Why choose that path? What do you see as the success as going direct to consumer?
Look, Dani, you asked the big question, and I think you're exactly right. We took the harder path on a lot of things. We took the harder path on the factory. We want to build and do it ourselves. We took the harder path in putting the supplier park right there in the plant, just yet. This is also where we'll do all of the accessories. And finally, on the direct to consumer, look, I don't disagree with the dealer model, but there is a better path. And that's exactly why we want to do it. And what you get is what consumers want. Consumers want pricing transparency. Consumers want simplicity. And look, things like the internet and things like Amazon have taught us very clearly customer data is important, customer service is important, and we're the company that engineered the car, we're the company that manufactured the car, and we're the company that's going to look after the customer throughout the value chain. So yes, it is harder, but it's the right thing. And the final point, if you look at 21st century companies, there's no universe where you would carry all of the manufacturing and the expense, but not also carry the cash register, if you will. And all 21st centuries have that relationship with the customer. They have the data control of the customer. And if you look at artificial intelligence, it's going to demand that you have the full value chain and not hand it off. So it's a critical strategic decision and one we're implementing as we speak, as you know, Dani. But it's definitely the harder route, but it's the right thing for our customers. It's the right thing for America.
Scott, you talking about simplicity. It reminds me when Matt and I went down last month to check out one of your cars, and you've really designed it to make sure that it is tactile, that it's not all screens. Do you think a lot of this industry, of this auto industry, has gone too far, that they've made cars, in the words of the President of the United States, where everything's computer?
I won't say computered, but 100%. We feel it, we know it, we see it in all the research, and you see it in every day, and we see the response to Scout. Look, simplistically, we've been trying to build something we call a connection machine. And we think vehicles have become sort of dystopian disconnection machines. Everything's 8 layers down, everything's on a computer screen, everyone in the car needs their own computer screen. And we think the exact opposite. We think mechanical switches give you a connection. We think less screens is better. We think bench seats are cool. We think tailgates are cool. We want to build this real, authentic connection. And look, I think some things don't need to be reinvented. There's no American that said, I don't know how to open a door handle. There's no American that said, I don't know how to turn the fan speed switch. And let's bring those things back and let's get down to basics. It also plays back to our heritage. That's what Scout was all about. Things were linear, straight, direct. And so, yes, I think that will be the trend. I think there's going to be a walking away from computering or computered everything, full stop.
Hey, first of all, I'm a huge fan of the tailgate. That was one of the coolest pieces that I didn't expect. I ordered I reserved the full BEV just because it's faster and it's lighter, and I feel like the battery tech is there to the point where I'm happy to experience that for the first time for me. A lot of other people, though, are going to only want a gas motor. Is there any possibility that you put out not just a hybrid, but a full ICE Scout in the future?
You know, I don't see it. And I look, there's a lot of drama now that says the world was all EV. Now the world's going to become 100% internal combustion engine. Is that? Look, we know there's a lot of whipsaws in the industry, which is why I always look for what is cool technology? What is an American looking for? And in my point of view, the best consumer proposition is exactly what we're putting forward. If you look at the 4 big pictures of what this drivetrain can deliver, to me, it's all American. So first of all, is there enough power? Over 600 horsepower, 1,000 pound-feet of torque, lots of power, 0 to 60 in 4.5 seconds. Does it have range? 500 miles of range. Does it have generator? So can you use a gas generator or an electric generator? And by the way, is it efficient? And you're going to be talking about EMPG of 70 plus miles per gallon. So this to me is a super machine. And I think Americans are going to say, this is awesome tech. I can have my EV coolness but I can have my ICE range. So we think it's the right way. And by the way, Matt, the other reason we love it is from an engineering point of view, it keeps the platform structure the same. It keeps the engineering at the plant the same. It keeps the manufacturing lines the same. So it allows us to be super efficient. And look, bigger picture, where is the world heading? The world is still heading electric. The technology is there. The innovation is there. We are in the early stages. Tech is only going to better. Costs are only going to go down. And we want to make sure Scout is prepared for the next 100 years. We're not building a 2-year brand and not be braced for now times only.
Hey, Scott, it's no secret Volkswagen is behind this. You have run Volkswagen. You've run Audi, the U.S. businesses. Keith, Monica, and Craig all said, hey, ask them if they're going to make Audis there. Ask them if they could make Porsches there, because those brands need a footprint in the U.S., right? And you're developing an all-new plant. Is that a possibility?
It's an absolute possibility. And as you know, there's been a number of press articles, so nothing I'm going to confirm or deny here. But certainly there's a possibility that other cool group products could definitely be built there. And of course, that helps with utilization, scale, and gives a natural footprint. But nothing to state here. But I think you're exactly right. If you look at this platform, body on frame, electric, body on frame, range extender, the capabilities, if you look at these segments, and whether Toyota Land Cruisers or Defenders, or of course Broncos and F-150s, these are popular segments. They're growing more popular by the day. So certainly there's an opportunity there, but nothing to announce yet, Matt.
Dude, a live rear axle for an EV is a pretty cool achievement. Scott
It is
Keogh,
super cool.
there from Scout Motors. Really appreciate your time. Hope you can come back soon. We want to stick, by the way, with autos on this program. Ford shares rising after the automaker posted an earnings beat and signaled it will largely bounce back from a fire that disrupted its key aluminum supplier. The CEO, Jim Farley, spoke with me and Bloomberg's Romaine Bostick about the impact of that fire.
This is really a retiming of wholesale. What we lose this year, we'll gain most of it back next year. Maybe $1.5 billion to $2.5 billion of EBIT this year, a little bit heavier on the cash because of how auto works. But we'll be gaining at least $1 billion, if not more, of that back next year. So it's kind of a retiming, very serious situation, but really proud of how the team dealt with it so far.
We also heard, as Gabriella Coppola just mentioned, that the headwinds from tariffs are really going to be cut in half. You had previously said you expected about $2 billion in headwinds from tariffs. Now you're looking at just $1 billion in those costs for this year. How did that happen? Is this just because of the proclamations that we got last Friday in terms of parts costs?
Yes, there was. And I have to thank Donald Trump, our president, and the administration. This is a huge benefit for America's largest auto producer. It did cut our tariffs to about $1 billion. It'll be about the same next year. This is basically a reduction of our imported parts that we make, that we have to import for our U.S. produced vehicles, finished vehicles. But they also announced a 25% tariff on imported heavy and medium-duty trucks, which is a big benefit for Ford because we make 100% of our Super Duties, our most profitable vehicle, in the U.S. We do not import it, but our competitors do. So a lot of things going on in the policy area, including the EPA, upcoming EPA decision on tailpipe emissions.
I am curious what type of conversations, Jim, that you've had with the administration on the potential for some sort of relief, if not equity, with regards to how much of your production is based here in the U.S. relative to some of your competitors, and whether they understand the potential disadvantage that would put you in if there isn't some, some sort of agreement to smooth that out.
Really good question. So Ford produces 80% of what we sell in the U.S. Here in the U.S. We actually export more, so it's more like 85%. We are way ahead of our competitors, even our domestic competitors. Some of them are only importing or making about 50% in this country. So the administration, Donald Trump himself, really listened carefully to Ford as we made our way through adjusting these new tariffs. And that was a proclamation we saw last week where we would moderate our tariff. We still have a tariff net, but this is a much more reasonable level. and certainly it rewards us as the most American car company. And you can see our tariff has been cut in half, basically. Now, we still have more work to do, but we're very thankful to the administration for the adjustments they made as we made our way through all this after the bilateral trade agreements with Japan, for example.
What conversations are you having with dealers right now, Jim, particularly when it comes to consumer capacity to spend, particularly given how high that we've seen, at least just general prices across the board, not just on Fords, but overall with regards to car prices?
The number one thing on dealers' mind and consumers' minds, of course, is affordability. We make America's best-selling vehicle, the F-150, for 47 years now, and that's what's on the mind of everyone now in the U.S. We're starting to see payments go out another full year to 7 or 8 year financing. It's not in Ford's captive, but some of the third-party finance companies are starting to see more stress on repossessions. That's not the case at Ford. We tend to have the highest end customers because of our prices. But that's on everyone's mind right now and a key focus for us.
That was part of my conversation with Ford CEO Jim Farley. Be sure to tune in to my podcast, Hot Pursuit, your weekly listen for car lovers. You can find it on Bloomberg Radio, Apple Podcasts, and Spotify, or wherever you get your podcasts. You've got to search Bloomberg Hot Pursuit, because I found if you just search Hot Pursuit,
Are there other Hot Pursuit podcasts?
There's other stuff out there, and it's not the same.
Inferior, I'm sure.
Yeah, you know it's a Dukes of Hazzard reference.
Yeah, I
Roscoe P. Coltrane.
Right, got it.
Okay.
Okay, coming up on the show, from costly compliance to constant scrutiny, Wall Street Week dives into why some of today's biggest companies are avoiding Wall Street, at least for now. That's coming up next. Time for our Wall Street Week conversation, and today there are over 1,400 private companies reaching valuations of $1 billion or more. David Weston explores the reluctance to rush into public markets and what it means for investors.
I have several friends who are CEOs of public companies. You know, the worst part of their life is the week before earnings day or the week after earnings day. You know, it's incredibly painful, expensive to have a public company.
Jonathan Foster is president and CEO of Angelus Wealth Management, advising high net worth individuals on their investments.
There's not a public company alive that doesn't pay at least $5 million and up for being public, and that would be for a microcap, right? So you imagine what the large companies are paying, and the scrutiny that you have from the public market.
It's not just the cost and hassle that can discourage growth companies from going public. Gordon Phillips is a professor at Dartmouth's Tuck School of Business who has studied the reasons behind the decision to stay private.
When you go public, you release a lot of information, so there's sometimes proprietary information that you don't want to convey.
Does that drive the impetus to stay private longer, in part because you can't necessarily patent the relationship between what you know
Correct.
and what the capital provides?
Right, I think it does. I think then you're waiting, David, to go public until you've established a brand name that's well recognized. You can think of Uber and Lyft. They wanted to wait to go public until there was enough consumers signed up.
And then there's perhaps the biggest reason that large, successful tech companies stay private for longer, simply because they can.
One of the reasons is because of the availability of private capital and the venture capital money and growth equity money that's available. So there's tons of money, so you can get a lot of money from private capital. You don't need to go to the public market as quickly.
But not all private companies are created equal, and most of them are certainly not unicorns.
They're not your typical private company. I think when most people, and regulators and others historically, have thought of private companies, they've historically thought of a family company or a small business or something along those lines. The companies that you're talking about are nothing like that. Those are real companies that are operating on a global scale.
Sarah Cohan Williamson is the CEO of FCLT Global and author of the new book, The CEO's Guide to the Investment Galaxy.
what's interesting about private markets is that the ultimate owner sets the price. So if you think about in private markets, who actually, if a company goes private, for example, whoever pays for that sort of sets the price, and then that's what the price is. In public markets, the marginal trader sets the price. So the price changes every day, every minute, perhaps. And so I think that one of the really important differences is how good are the valuations on different sides. And so you mentioned some of the companies that are valued very highly, and those may be very accurate valuations, but a lot of times the difference is between a mark and an actual trade.
That was David Weston with the Wall Street Week on private versus public companies. You can catch Wall Street Week every Friday at 6 p.m. New York time. Coming up, we'll set you up for the trading week ahead as stocks hit record highs again. Michael Ball joins us from the MLive team. This is Bloomberg Open Interest.
Let's get you set up for your trading week next week. Monday is going to kick off with another busy stretch of earnings. We'll hear from Keurig Dr. Pepper, among others. Wednesday, that is the Fed decision, plus tech earnings pick up. We get Microsoft, Alphabet, and Meta. Then on Thursday, President Trump and China's President Xi will be meeting in South Korea, and then even more tech earnings from Apple and Amazon.
All right, joining us at the desk to talk about what you need to be paying attention to, really today, but also through the weekend and into next week, Michael Ball. He is Bloomberg's macro strategist. He writes for the MLive team, which is an indispensable tool. I absolutely love to type MLIV Go and see what you guys are up to. You've just published on the CPI number, which is behind, at least partially, this rally, right? And S&P PMIs. What do we know?
Yes, CPI was the Goldilocks. Came right in. It wasn't too weak, which would have probably brought growth worries out. You know, we don't want to see companies unable to pass through the cost increases we know they're getting. We also want to see the consumer showing up. So again, not being too low is actually a positive, but also we didn't want it too hot because then we bring into question what the Fed's going to be doing in December and in 2026. PMIs, the headline was good. Service side was certainly hot. But when you looked under the hood, you know, you had some kind of stalling in hiring again. You had some margin pressures, and there was confidence problems. And that echoes some of the other PMI data we've already seen. So nothing surprising, but overall, you know, wasn't really too buoyant. So that's probably why we saw the SPX get up to around the 6,800 level, bounce off, and then now it's kind of trending order.
Where is the event risk for this market? We were just talking about in the break how the market didn't see a lot for this today, the data coming in. But next week you have all those tech earnings, and then you also have the meeting between President Xi and Trump.
Yeah, again, next week is the real earnings show. As we all know, we have to see if this AI CapEx story continues. And I think a lot of people are already on top of that. With what we've already seen from TSMC, ASML, Samsung, everyone basically except for Texas Instrument, pretty good stories. Intel clearly today having a good one. I think the big thing, as we all know, is the U.S.-China Xi-Trump meeting has to be smooth. It doesn't necessarily have to be great. It just has to pass without any sort of real catalyst that would bring trade war problems again.
But it's funny that this market will rally if Trump gets Xi to buy soybeans and Trump gets Xi to sell us rare earths. Because before Trump, they did buy soybeans and they did sell us rare earths. So is there any forward motion there?
Yeah, Trump's sort of losing the farmers, which has been interesting with the Argentina story and obviously with the beef stuff. Now he needs to sort of make up for that by allowing, you know, exports to continue back to China, and China's been very tactical with that. I think it's not tit for tat. We certainly need the rare earths more than China needs soybeans, so it's going to be interesting to see how this plays out.
It has a feeling of doing a lot of work, literally just to stand still. Michael, thank you so much for joining us this morning. That is Bloomberg's Michael Ball. All right, that's it for your Friday show, but a stack show coming up on Monday.
Yeah, we do. RBC strategist Lori Calvasina joins us. We love her. Genco CEO John Wobensmith joins us. We'll get a great read from him on shipping and talk a little bit about that aspect of U.S. trade, China trade as well. This is Open Interest.